Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, see what people are sharing, and I'll interject my financial opinions as we do it. If you want to follow me, it's at @Finance. If you want to join our community, finding-value.com, where I dive deeper into all of these topics and subjects, looking for potential investment opportunities and sharing those opportunities with everyone in the community. I am a long-term investor. I try to find companies that are really low and underpriced. I also use technical analysis to try to time my entries as best as I can. I do prioritize value over the timing. I do look at the long term and prioritize long term returns over short term kind of trades or swing trades. And that's kind of how I'm investing for this commodity bull market. If you're interested in joining, we do have a special coupon code. Special is the coupon code, and you get a 50% discount on the first month only, and a larger discount on the yearly membership. So let's dive in, take a look. We've got Howard Marks is worth $2.2 billion. His memos offer a masterclass into how billionaires approach investing, and I am trying to adopt everything that I can of these very successful investors that have invested in the markets and haven't blown up. What does that mean? A lot of the traders through history, they've all blown up. They've blown up many times, in fact. These other guys, they've never really blown up. They've always gotten wealthier and wealthier, and obviously they go up and down over time. But blowing up means like actually going to zero. So here is his top 7 lessons from selling too early. So in his opinion, only the long term matters. The short term doesn't matter. It says make decisions for 5 years, not 5 days. Be long term greedy. And I've tried to implement everything I can from the longer term, getting early entry points, holding on, and there's going to be volatility with a lot of these, no doubt about it. It says wealth builds over time, not through perfect timing. Trying to time bottoms and tops never works. And I see a lot of people on Twitter, a lot of people on YouTube, they are trying to time the market. They are using technical analysis is usually what they use. They try to use chart pattern recognition. And I do think that works to some degree, but I think you want to back it with fundamentals on top of technicals. It's a hybrid approach that I've adopted at least. And then you take a long-term outlook and you get a really cheap price with an undervalued company with a good technical entry point. Now you're starting to put together the alignment that I try to do. It says the rule of price predictions, they're always wrong. Stay in the market so you don't have to rely on being perfect. Ride through the volatility. And I know we've had some volatility, especially in the energy space here recently. And a lot of people, what they do is they have price impact their emotions. Their emotions then tell them to sell and they liquidate based off of that volatility. It says it's rare to find investments that compound, or it says find investments that compound over time. Don't let them go. It's rare to find investments that compound over time. BTC and ETH are 2 examples. SOL has a chance. Thousands of others have failed. When you find compounding assets, hodl. It says buying the top isn't the worst thing. And I don't know if Howard Marks is talking about this or if this guy who's posting, but it says, look at Michael Saylor. He always buys the top. But ask anyone around here. Well, you also have to remember Michael Saylor went broke last bubble. This guy's Mr. Bubble Boy, and he knows and finds all the tops. So I wouldn't be using him as a good example. But anyway, but ask anyone around here, and in 3 to 5 years, most agree he'll make a killing. A temporary top is preferable to missing out entirely. It says activity doesn't always equal value. Do you know who outperforms everyone? Dead people do. That was a study done by Fidelity. They don't overtrade, get rugged, or fall for shiny narratives. The market rewards inactivity. Tough one for me, and I imagine most people terminally online. It says be willing to change. And this is, he's putting that in there, this guy who posted it, Louis, he's putting these things in here about hodling compounding assets. I think BTC and ETH are absolutely worthless. They don't cash flow. We have no idea what the value is. And I'll go in it maybe after this. Um, be willing to change things. Yeah, we'll skip that. Profit from fear. Don't let the CT bubble fool you. Retail thinks there'll never be another cycle, and crypto is a scam. It is a scam. Make the choices 99% won't. But Howard Marks is, he's got a lot of good stuff. Kevin Carpenter says, Charlie Munger, lots of luck if you're an impulsive person who has to be gratified immediately. You're probably not going to have a very good life, and we can't fix you. Says that demand for immediate gratification is the way to ruin. It may also give you syphilis. I thought that was funny at the end there. Um, but yeah, I mean, if you're impulsive and you need things to work out immediately, long-term investing doesn't work. And then if you are a short-term trader, well, they don't make any money. So you're basically screwed. You won't make money. If you're impulsive and you do not adopt a long-term outlook, those people don't make money. They just blow up and go broke. Jesse Livermore, the most successful investor or trader, most successful trader in history, went broke 3 times. That's success. That just sounds like gambling. And you put everything in, you go on leverage, and then boom, you're done. A few mistakes. Then you hear, well, it's a problem of the strategy. It's like, right. Where are these billionaires all over the place that are traders? There is no. So I look at the people who are successful, who are billionaires, and what they're doing and how they make their money. They buy undervalued assets and then they just sit on it until the market condition changes. That's it. And they do it over and over and over and over, and they're extremely patient. There was a debate going on one of the quotes that I had read last time is it's indistinguishable to tell when someone's too early and if they're wrong. And I've stated that the oil market is in a bull market, and we've had a pullback here recently, but we're still in a bull market. And other people say, well, you've underperformed, let's say Nvidia or some like top performing tech stock. Well, the one company I shared on YouTube was SM Energy, and I'm still in it. And I purchased it in 2020, which is at the beginning of this chart here. It's actually still outperforming Nvidia. It's absolutely waxing Tesla, and it's killing Google. These are 3 areas. You can put whatever else in there. You can put Amazon. They're just little blips on the bottom here that you can barely tell they moved. And I'm only sharing SM Energy just because that's one that I shared on YouTube. And there's ones that have outperformed SM in the oil sector even better than this one, that are up 3,000-4,000% since 2020. Does that look like underperformance? Is that too early? Is beating what everyone else thinks is the best, is that too early? What is too early? Is too early underperforming the market? Is too early waiting a year or two of having not much performance and then you have a gigantic amount of outperformance? I wouldn't say it is. I would say even if you waited for a year or 2 or 3 or 4 in the beginning, and then you had a 5 to 20 bagger that came year 3, 4, 5, you definitely won. It's not too early. Too early is when something never comes and you underperform massively for a very long period of time. But even so, you could have strategies where you can still underperform in a sector, but if you're in 6 or 7 different sectors that you chose and you massively outperform in 3 or 4 of those, your total performance is still better than maybe the performance of something else, a different strategy. So I don't think it's about getting everything right. I think what it's about is having a strategy that you deploy that produces returns better than other strategies. So people can pick. They can say, well, NVIDIA outperformed from this time frame to this time frame. The question then is, did you get that performance? And they'll say, well, no, I wasn't in it. It's like, well, then why the heck does it matter? You could obviously look backwards and compare with 2020 vision what the best strategy would have been. And that would have been from jumping from one asset class to another asset class to another asset class. But you wouldn't have known when to exactly jump. Another thing is it's very dangerous to go and buy extremely overvalued assets. So just because something isn't moving in an undervalued asset doesn't mean that it makes sense to go and speculate or do something in another different asset that is way overvalued. So if you were to take out all the overvalued assets, what are you left with? You're left with the undervalued ones or fairly valued. And then you want to buy the undervalued stuff. So now you're just stuck back to where you were in square one, which is with commodities and precious metals and miners and stuff like that. And I know it can be frustrating if things don't move immediately, but that's the game. That's what we're trying to figure out. That's what you need to learn. Kevin Bambro says it's time for an explosion in silver stocks relative to gold, and I actually agree with that. Based on SILJ, silver miners versus SLV ratio, I decided to go ahead and convert more physical ETF silver into silver juniors. It says this ratio just hit extremes for the third time this decade. If history repeats, I'll be making multiples just like in 2020. And I agree with that. You can also do, and I'll move this over here. You can also do SILJ divided by GDXJ. Oops, I wasn't on this there. And you can see the ratio of SILJ historically has been really good at these particular times in history here. And that's most likely going to have an outperformance at some point of SILJ over GDXJ. You can also look at SILJ divided by SIL, and you're on the cheaper end here. And these are the moves that you want to capture as they go on up. So yeah, I see the same thing as what they're saying here. It's a totally valid statement. Steven says, how's the best week ever for a momentum thrust? It says, these diversified global equity ETFs just booked their largest weekly outperformances in history versus the S&P 500. MSCI EAFE, we've got Stocks 50 and All World X US, the EU. Germany, France too. Looks like international leadership has legs. What's causing this? Why is this the best week ever for the rate of return and these ratios? It deals with the dollar. The currencies are starting to change. So if you were to look at, say, something like the GBP USD, you can see that we're starting to break out of this down, this consolidation here. We've broken out, we've done a retest, and now we're starting to head higher again. This is going to manifest itself in outperformance of some of these European ETFs. So, I mean, this is what's the driver. I wish I knew this stuff when I was earlier and what the drivers are. So, yeah, I mean, this is, in my opinion, what's driving it. Who's ready for the new world order? International equities have arrived. And again, remember that weaker dollar. This is iShares MSCI Germany ETF, EWG, and it's breaking to all-time highs, which is a big deal because this is a big resistance area that we're breaking. It's probably going to have a massive run. And what this is, all this is just money flows shifting in the market back and forth. And the DXY and these currency exchange rates are what are causing these shifts. So if we notice on the DXY, we've had a monster move lower. That is what's translating into this move higher. And that's EWG. Let's take a look at it ourselves here. Yeah, that looks insane because there's your resistance and there's your breakout. And you're also seeing that the lows are coming up here. And there's your breakout. So that looks absolutely fantastic for potentially a big move. Now, there's a possibility that we get a return move and a retest. It always is possible. It depends what the currencies continue to do. And I think we're going to see this across the world in a variety of different asset classes based off weakness in the dollar. Warren Buffett says rule number one, never lose money. And rule number two, never forget rule number one. So you never want to lose money. Now, here's a question. How do you prevent loss of money? These guys are long-term investors. When you take a position, you're almost always going to be down on the position in the beginning at some point. So what is losing money? What does that mean? Well, it doesn't mean volatility. It doesn't mean that you won't be down in your account. That's not losing money. Losing money is when you take a permanent loss, where you invest in a company and the company's fundamentals are so crap that maybe the company goes bankrupt. And that's what I think he's talking about is don't choose companies that are going to lose you money. Like if you know the company doesn't make cash, he's not going to make the bet. So what I found over all these years and kind of studying Buffett to some degree, Buffett just buys boring companies that do not change. Food companies, insurance companies, things that basically technology will help. And then the technology companies, a lot of them he avoids because technology can be replaced with something else that's newer. So he goes after companies that are like food and beverage, ones that do well in a variety of market conditions. And then he tries to buy them when they're undervalued. Like that's it. That's the whole thing. So never losing money doesn't mean that you'll never be down on your account. What that means is taking a permanent loss on a position where it goes bankrupt or something on the lines of that. So if you were to apply some of his rules, you wouldn't ever be in a junior mining company. You would never be in a uranium company that doesn't make any money. You would never be in a lot of these companies that do not produce positive cash flows or positive earnings. He would avoid almost all of them. I think one of his rules is that they have 2 years of positive earnings before he'll invest in it. So that is one of his rules. And he wants to see stable growth. Stable growth, obviously, a lot of commodity companies don't have stable growth because they don't control the selling price of their product. So it's a little bit rougher area to make money in because of the volatility of the commodity price itself, throwing around all of the, we'll call it all the financial measures that we use to measure a company, return on equity, all that stuff. So that's a little bit about Buffett. The narrative collapsed. Charging EVs gets costly in California. California EV sales in 2024 were nearly identical to 2023. Charging an EV at home at California's average residential electricity rate is 90% as costly as fueling an efficient gasoline car, reducing its appeal for those considering a switch to electric. So that is electric vehicle charging costs border gasoline costs in California. They also have a little bit more expensive electricity costs. And I don't think charging electric vehicles all that convenient is what I'll say. Gold sees its largest 4-week inflow in history of about $5 billion. Look at that. Look at that inflow there. It's big. Crazy. Here's lumber. So I love how lumber futures are shaping up, and it looks like it's ready to break through resistance here to the upside. A nice little double bottom going on here. In a potential break, you might get a little bit of a sideways action on top of this and then a break higher. So lumber's looking really good, and that's a feedstock for an expansionary phase of real estate. Lumber prices generally go up in an expansion phase of real estate. So are we in an expansion phase of real estate? We are. And could a recession have an impact? It could, depending on what the recession. Usually, the majority of recessions come from the real estate market. So if we're going to recession, you see lumber going down, not up. Usually. Here's Grady. This is gold versus the M2 money supply. This chart shows how undervalued gold is relative to the U.S. currency supply. And since gold is the hedge against currency debasement, and since inflation is caused by an increase in the currency supply, this chart has a very, very long way to go. The global elite will make it happen. And then gold's going to get a revaluation against the M2 money supply. And that only occurs during commodity bull markets. 82 all the way down to 2000. Then we had a commodity bull market with a weakening dollar. And now we're going to enter another big commodity bull market with a weakening dollar. It says a reverse symmetry move is quite likely, and that also fits timing-wise with posted gold long cycle charts. So that's what's occurring there. A new update, Dow to commodities ratio from Goring and Rosenzweig. This is what it looks like right now. And some people are comparing it to back here. They're like, oh, this could be, to me, it looks like we're at like 68, 69. So your little move higher there is the first little wave up. And then we'll move on up to the, hopefully, an overvalued state. If you work your way from here all the way up to an overvalued state, the outperformance is going to be massive against the Dow Jones or against stock market. And everyone is piled over into stocks. They're not in commodities. This is the chart that shows you that exact thing. It is a fact of what I'm saying because of where the ratio is. Money's all piled over into financial assets while commodities are incredibly cheap. We already know that. There's only a couple other times in history that it's been this cheap. In the 60s, it was like that. In 1929, it was like that. And in 2000. Those are also bubbles of every single time. This was a real estate crash in 1929. This was a real estate boom occurred here. And it was another real estate boom in 2000. And we have another real estate boom coming. Basically, we're in it. So I do think that this is going to work its way on up. The conditions are there for that to happen. Shabam says, there are only 16 public E&Ps left in America with 100,000 barrels plus per day of oil production, with Marathon now part of COP and Hess closing soon. Incredible transparency of current production along with future guidance. It allows OPEC Plus to see a widening supply-demand gap and to act accordingly. There's going to be a wide supply-demand gap coming. And I don't think people understand this. Like, they look at the potential of what the world can produce, not what the world can produce in steady state. So they'll say, oh, well, we could surge to 4 or 5 million barrels. It's like, okay, steady state, we're at like 1 or 2 maybe. That's it. And the whole bull market, last bull market, we ran up with 2 million barrels of spare capacity. And we've got a very different, in my opinion, I think we've got a different situation coming up here than what we had in the 2000s. Money Wisdom, it says, if you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks, says John Bogle. This is one of the leading indicators of a recession. So today, residential building construction employment, which is usually in contraction well before a recession hits, hit a new seasonally adjusted cycle high. Well, how could we have a recession then? We don't. We don't have one. This is the data most likely saying that we don't have one. Usually you get a turn lower in this before you get a recession. And this is what blows up your unemployment. So you can see here, it turned over well before the recession of 1990. It turned over in terms of your home building, 2001. It turned over before 2008, and it hasn't turned over yet. So we're not at the top. That's my guess. And I think we're going to go a ways, being at a pretty high level for all employee residential building construction, because we have a pretty big shortage of homes. And people still debate that. I don't know why people debate that in the comment section. They're like, oh, well, how come home sales are down? Well, maybe that's an affordability problem. It doesn't mean that you have a hyper supply phase with no inventory. I mean, this isn't rolled over yet. Like, it's got to roll over for me to be like, okay, now we got a problem. Yeah, that's what we've got there. Colin says, I'm seeing more folks come around to the idea that rates prices can fall in tandem. Morgan Stanley strategists anticipate that mortgage rates could fall with treasury yields over the next 2 years, and home prices may decrease slightly amid increased housing supply. And this guy's pretty good. He says, here's the issue I have with that outlook from Morgan Stanley. If we do see additional supply due to falling rates, which I think is reasonable to expect, it's going to be people who are currently locked into their homes by their ultra low rate amidst a higher rate environment. The sellers will contribute inventory to the market, but they will have no net effect on supply overall. For every home they contribute to inventory, they will also take one out. They're also buyers because they needed a place to live. The only way that supply increases with improvement to affordability is with building and more units added than households. We are long away from that. We are in a housing bubble. A bubble indicates that we have a bunch of inventory. That is a bubble. That's a hyper supply phase. If you have no inventory, it is therefore incongruent that you are in a bubble. You can't use bubble interchangeably. You can't use price as a determining factor. And then people say, what do you mean you can't use price? Well, price is one aspect when you price something in the dollar. But if the dollar fell 40% and your prices of homes went up 40%, is it because the price of the home went up or the dollar went down? And that's why I use ratios. The genius in all this is using the ratios so you can take out the dollar movements, because they lie about inflation, they lie about the dollar, and you can't use it as a reliable measuring stick over time. So you have to go into something else. You have to measure something that is outside of fiat currencies. Hence, your gold standard. So then I hear a lot of people, they talk about the revaluation of gold, and that that we could potentially not have inflation. They'll just revalue gold. I hate to say it, guys, but revaluing gold is going to revalue commodities higher. 1 ounce of gold was revalued back in the 1930s. They revalued it. And guess what happened to all the commodities? They all revalued higher with gold. The ratio going back to the 1800s for oil to gold ratio hasn't really changed much. It's been between 10 and 30 the entire time, with the average being between 15 and 20. And if you revalue gold upwards, you're effectively revaluing all commodities upwards massively. So you can't be like, well, we're going to revalue gold to $10,000 an ounce. It's like, if you revalue it to $10,000, oil might be $500 a barrel then. You say, well, people can't afford it then. It's like, well, then you can't revalue gold then. All of this stuff is interconnected. You can't revalue one without revaluing the other stuff that comes with it. Your revaluation is the revaluation of the currency lower. That's what you're revaluing. You're not revaluing just one little facet of gold against the dollar. It's revaluing everything. You've printed too much currency. Silver miners leading silver by nearly 3%. Bullish. I saw that. That looked pretty good. That's SILJ divided by SLV. Here's David Burrows. He says, it won't be a straight up move, and history doesn't always repeat, but recognizing change points, however improbable it seems, is a key to long-term success in markets. And this is gold relative to QQQ. And it's starting to, if you look at the right hand, it's starting to break out. The beginning of the tech bull is when it peaked in 2011, 2012. That's the beginning of the bull. Your cycle is from 2000. This is the end of the last tech market, bull market. There it is at the bottom there. You can see it over here. This is the beginning of the commodity bull market when this ratio started to break out. Beginning of the bull market here, it ran all the way to the top. It peaked. It was a double top. This is your beginning of your tech bull. If you were savvy enough to identify it. How could you identify it? Well, your ratio of commodity stock ratio was high. So commodities were overpriced and your technology stocks were underpriced. You want to go long tech here. You could have gone long in tech in 2008, 2009 as well. And then you had to wait a year or two. You weren't wrong, you were early, but your payout is so big, it didn't matter. And that's where people, I don't think they understand. You got to get into this cycle, live, eat, and breathe the cycle. Then you can't unsee it. It's in your brain. Cycle of tech is here to here. The reversal occurred in 2020 was here. 2022 was the ultimate bottom here. And then we peaked, did a double bottom. This is retest from the top of the downtrend and reverses. There's your double bottom in 2024, and we're starting to just break out of the trend. This is a confirmed breakout, not the process of turning. Now, the ultimate return actually occurred in 2020 here. 2020 was the turning point for some other bottoms of commodities. And that's where I entered a lot of mine. The cycle is still legit and we're going to break and move up. Being a little bit early here doesn't matter because the payout will be so big that you want to be able to position earlier than maybe some of the others in some of these stocks. Now, you're not early if you bought in 2020. I could pull up a variety of things and I'll just pull up SM Energy again. Buying this falling wedge into the corner here was one of the best decisions of my life. It changed it. And buying that entire area all through here for this move on up, and this is going to move up because we're starting the cycle. The bull market started here, and we are going to go probably to some level. This is logarithmic. I'm just going to clean it here real quick, where you're going to get a absolute beast of a move where and then you get a shoulder, head, shoulder, and then you're going to get a breakout. But people can't handle the volatility. They can't handle buying the bottom because they never can hold on. And then I'm getting volatility here while that's going to break and move on up. That all correlates with this move here. It's all interconnected. Your commodity bull market was from 2000 upward, and now your commodity bull market started at, here's the bottom of it, and it's going to start to run and outperform these other asset classes like QQQ. It says significant reduction in net oil length over the past month, a proxy for the financial demand for oil, to now levels which historically have coincided with price bottoms. So we're pretty close to a price bottom. We've got our big pullback. You can draw a trend line through here as well. We've been bottoming around, and we're probably going to work our way on up in a bull market in oil. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Special coupon code. This is being released also at the same time we're doing a Q&A session at 5 p.m. Mountain Time. It's not released at the same time, same day. 5 p.m. Mountain Time if you'd like to join the website. Special is the coupon code if you'd like to join. But we'll take advantage of this. I'll show you guys some things that are bottoming that I really like in terms of companies, and that's all I've got. So we'll catch you later today. Don't forget give me a thumb up, and we'll see you next time. This is Finding Value.